Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that recently saw a violent move down over the past couple of trading sessions. Since we posted our last couple of videos, we've seen an aggressive move down here from the all-time high, around a 5% correction. Lots of panic in the market right here at the bottom. And then the markets reversed, snapped back above this support trend line with what seems like a bullish type of candle. So we have to ask the question, was that it? Was that the correction that we've been expecting, the Federal Reserve tightening scare? Is this what we needed for the markets to refuel and head on higher to continue what I believe is the final stage of this huge bull run we've seen since 2009, very likely pushing the S&P 500 into extreme valuations that we have never seen in stock market history. By the way, this is a chart that we tweeted a couple of days ago. It's basically a PE ratio that's adjusted for inflation, giving you inflation adjusted valuations of the S&P 500. And of course, we are at the top end of that range, but that's not going to be the focus of this video. By the end of this video, you'll know exactly what kind of setup we're forming on the S&P 500. We've been calling for some volatile swings on the S&P 500, some big trades to make both to the downside and to the upside. So we're going to be going through that in detail in this video. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. And now without further ado, let's get right into it. All right, so I'm going to begin by discussing some of the more bullish developments before we dig into the bearish ones, and then we'll draw some conclusions on how we can benefit from all that information. Now, this is the fear and greed model. It's something we use a lot to determine what the market sentiment is. If it's at extreme greed, we typically want to be booking profits. If it's at extreme fear, we want to be taking positions because it's telling us a lot of cash is on the sidelines. There's a lot of buying power to push the stock market higher. So you can see throughout the past 3-4 months, we've been in a fearful market. Lots of fear in the stock market right now. We had the Evergrande scare. Now we have the Federal Reserve tightening announcement that's causing a lot of uncertainty. That has put a lot of cash on the sidelines, and it can definitely fuel higher highs in the stock market. So that does increase my confidence that, contrary to what many people are saying online, on Twitter, on YouTube, that this is not a bull market top, that we could see a little bit of a correction. We're going to talk about that, but it would not mark any type of long-term top in equities. I really want to be seeing broad bullish sentiment towards the top, not this type of fear right here. Now let's quickly take a look at the volatility index of the S&P 500. This is a chart that is just so useful to look at if you're looking to benefit from swings on the S&P 500, right? When volatility increases, it means there's panic in the market. It means the markets are tanking down, investors are taking big losses, and there's an increased amount of irrational behavior in the market. That's typically when you want to be stepping in to buy the S&P 500, right? If we put the S&P 500 on top of this chart, and you can see I haven't moved these arrows since the last time we covered that. I do believe these were drawn on some of the last YouTube videos that we made at around these lows. You can see both of these lows corresponded to buying opportunities in the equity markets. And you can see the VIX now is reversing off resistance. Now, what does that mean? Does that mean we've made another bottom and we're about to go parabolic? Probably not, but it does mean that the market hasn't decided in what direction it's going to go. You have lower highs on the volatility and higher lows as well. So we have contracting volatility. At one point, this is going to break down or it's going to break out. And that leads me to this next part of the video where I discuss the short-term bearish developments. And this is where I want to show you this wedge pattern here. This is just a beautiful, beautiful wedge pattern. Now, as someone who loves technical analysis, loves chart analysis, I'm very well aware of its weaknesses. And it does tend to have a bad reputation because people tend to use it to justify their own bias If you were paying attention to some of the other YouTubers covering the stock market throughout this massive rally here, you would have seen a number of wedges being drawn out. That was just absolutely ridiculous. And then they would just tend to redraw the wedge to fit whatever bias they had. But here, this is just textbook wedge price action. This is so beautiful. We have an uptrend line here capturing very important levels, right? These candlestick tails, these daily closes, even this snapback above the trend line here on this recent correction. And we have a clear roof here. So that's beautiful, contracting price action with price making steady higher highs and higher lows. And with the momentum, so the RSI, telling you that momentum is fading on this rally. So it doesn't get any better than this from a wedge standpoint. Now, short term, how is it going to play out? Are we going to make a marginal new high before breaking down? That's possible. Are the markets just going to reverse now and break down? That's also possible. The point is the risk reward here is relatively unfavorable for the S&P 500 in the short term. Now let's play the devil's advocate here, because I know I am going to get some questions about this, because the community that we have on YouTube and on the website at gameoftrades.net just gives us so much feedback and so much food for thought by the comments that you make. I know I'm going to get the question, why don't you think it's possible that we actually break out of the wedge? And that's when we get that FOMO and all that cash coming back into the market and get that parabolic move that we've been talking about. And that's why technical analysis cannot be used alone, right? Because that can happen. There is a probability that that can happen. And the answer to that question lies on what we've been covering for a couple of weeks now, which is the stock market breadth. This is the S&P 500 market breadth. So the number of stocks that are above their 200-day moving average, you can see that it's been trending down violently throughout the past few months. So when I see divergence between price and momentum, contracting price action in a wedge, and the breadth, that's telling me that very few stocks are participating in this rally. I just don't see this wedge pattern playing out to the upside. Now, of course, anything can happen. Could we see this type of breakout on the breadth? You know, that anything can happen. But what would be the point of this channel? Why would you be coming to this channel if I just laid out every possible scenario? Right now, we're leaning short-term bearish. Usually these types of divergences between the price and the market breadth lead to more significant types of corrections. That tells me we could see this wedge pattern play out. If we take the measured target from this wedge, right, which is the widest part of the wedge, you take it out to the breaking point of the wedge. Let's say we break in a couple days here. That could take us down to these levels of support, also corresponding to the 200-day moving average. We've discussed that. That remains our preferred scenario right now. And if we get there, if we get that retest of the 200-day moving average, stocks are going to be oversold, right? This breadth is going to be very low. And that's very likely to provide the fuel that's needed for a major rally across all the sectors in the S&P 500, whether that's financials, industrials, the technology sector. If you have the breadth rise like this, it's going to be a broad, very strong rally, the type of rally we had throughout this period here. And this is where all of a sudden everyone flipped bullish. If you take a look at the number of bulls in the market, AAII Bullish Sentiment Survey, right? It tells you how many people are bullish on the stock market for the next 6 months. Look at this spike here. This was in April of 2021. We just have not seen this type of rally since then. And if we have that type of correction, the breadth will be oversold, and that would leave a lot of room for a very broad recovery. All that money that we're seeing coming out of the bond market right now, with TLT that's just been breaking below all of its key moving averages here, just sliced through them in one move. That's very bearish, and I think that's going to continue. The money coming out of treasury bonds is very likely to end in the equity markets, as it always does, and fuel a very, very large rally to most likely a top that we won't visit again for decades. I know this sounds all extreme, but just look at the data. we're seeing extreme market movements, extreme valuations in an environment with extreme liquidity, extreme central bank, extreme monetary and fiscal intervention, and all of a sudden a 180 turnaround from the Federal Reserve telling us that they're going to start tightening. So we're going to go from an environment with extremely easy monetary policy to a place where they can potentially make a policy mistake, tighten too quickly, and cause this bullish momentum in the financial system to do a 180-degree flip. We have every intention on taking advantage of these moves, both to the upside and to the downside, protect our capital from any type of drawdown in the financial system, which I do believe is within the cards for the next couple of years. Every week, we take a look at the stock market. We take a look at economic data, growth, inflation, and we tell you whether we think it's a good idea to stay invested in equities or to begin positioning for the next phase of the market cycle, which may not look as pretty as what we've seen up until now. So if you're interested in checking that out, make sure to click on the link down below and test out our free trial at gameoftrades.net. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.